Alrighty, let's go ahead and get started. Welcome everyone to the HUBB Live Trading Room. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do need to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. Other than that, it's cue Led Zeppelin, as the song remains the same. Anyone that's been around with us for some time understands that reference, and i.e. what that means is waiting on Chairman Powell's speech Friday at Jackson Hole, and what the rate cuts, if there is going to be a rate cut, will look like, and the impact thereafter. So without further ado, let's go ahead and get into all those exciting topics. Thank you again for joining us live. Very excited to interact with you all. And as I said, let's get started. Rob, you out there?
I'm Zack. Hey, everybody. Welcome to HUBB Live Trading Room. And I am away, so will not be on camera, so I'll spare you that. But as always, watching the markets, never too far away from those. Let's talk about the markets real quick, and then we'll get into the AI stuff, which is the crux of this class, as you all know. And you can see that on this ascending pennant pattern, we are trying to sneak out of the downside today. Yesterday, we were able to close right on the 10-day moving average and right on that lower trend line. And now we'll see if we do close below the trend line today. Still a lot of time between now and when the market closes. And then it kind of brings in a conundrum, because you know the rule. You have to have a follow-through or confirmation day. That would count in this scenario as well. In other words, if we were to break out of this ascending pennant pattern, then we would look for, in other words, close there today, we would look to see if there's a follow-through day tomorrow. But tomorrow's Thursday, and then we get the long-awaited speech from Chairman Powell. I've been opining that I don't think he's looking forward to this appearance, knowing that he's going to get a barrage of questions on whether or not the Fed is prepared to cut rates, if he's going to tip his hand that perhaps a rate cut is coming at the September meeting. And then obviously they'll want to know how much it's going to be. We're at an 83% chance on the Fed fund futures of some sort of a cut in September, but the market wants 50 basis points. And I think that could be a disappointment. So what if the Fed does cut, but they only cut 25 basis points? Would the market react positively to that because it's a rate cut? Would they be disappointed because it's not 50 basis points? So you can see that there is a lot of intrigue this week as we await that big speech on Friday. So that brings in, if we do have a follow-through day tomorrow, we do have the SPY puts in the speculative portfolio for just such a scenario as this. But even if we get a follow-through day tomorrow, could that be completely reversed on Friday if Chairman Powell seems a bit more dovish than he did at the last meeting? So a little tricky time here as far as picking the next direction of the market. Couple things to notice. Looking at the algorithm, the HUBB Ellie wave algorithm, you can see that the wave 3 is still green, meaning that even with this tick down here, the algorithm is not sure that wave 3 is finished yet. We still could go higher. And the AI has been giving us this 652 target for months. And we got awfully close to it. We got to 650. We just didn't quite make it to that last little tick up and hit the line exactly. And then we've been wondering, would we hit that level first, then create the wave 4? Will we create the wave 4 and then go up and hit that level? All that stuff still remains in doubt with where we sit right now. So these are the kind of times where you just exercise patience. And in talking about the AI, I am going to get to the VIX and the bond market before we get deep into the AI, but I would like to remind you, because I've seen a couple comments. I know we add subscribers all the time. People are excited about getting the AI signals, et cetera, and expecting there to be lots of alerts coming out. But every time the AI does this, every time it goes through a series of not sending out a lot of alerts, it's been the right move. In other words, the AI is not quite sure where we're going to go. When we look at the macro signals, which I showed you in the US market update over the weekend, hopefully everybody looked at that. It does show from a macro economic standpoint, the market is still in expansion. We do have a heightened level of contraction, so it's kind of a pick and choose what areas of the market are expanding, which ones are contracting. So kind of a little bit for everyone from that standpoint, but don't get frustrated if you're seeing a lower number of alerts coming out than what you want. Again, every time the AI has done that, it's been the right move just to take a pause at those points in the cycle. So that's about it for the S&P. I'm going to look at the bond market because that's been kind of interesting to me, where the bond market doesn't seem sure at all on what the Fed's going to do, Chairman Powell, with these upcoming meetings and the potential for rate cuts. And you can clearly see this. I talked about this yesterday during Trade Finder and also on Monday during the EWO Trader Live webinar. Very unusual to see this many triangles, indecision everywhere. If you're a fan of dojis, etc., you would see from a weekly standpoint, I would imagine a lot of dojis indicating indecision. So candlestick charting people, I think, can relate to what's going on here with the bond market. If we go back a bit, we had the unusual movement in the bond market. So we kind of gone from one extreme to the other, which is the market does that a lot, doesn't it? When it overreacts one way, it tends to. This is the prices and yields move inversely, so prices go up, yields and rates go down, and vice versa. When we look at the TNX, that shows rates on the 10-year. So not sure why they do it differently, but they do. And so we had this wave 5 pattern to the upside, followed by a wave 5 pattern to the downside. So a lot more movement than we normally see out of the TLT. And then now we're going into an abnormally long sideways contraction with all of these triangles. Triangle, breakout, triangle, moved down, had a false breakout to the upside, came down, formed another triangle, another false breakout to the upside, and then the big move lower. And then we've been consolidating that move since, which is why we talk so much about market head fakes. The market loves to do this, where you get these false breakouts, and then the big move lower, false breakout, big move lower, and then all this consolidation pretty much since May now on the 20-year. So I think we need to heed what the bond market is telling us, that there's uncertainty moving forward with where things go. We'll get an update on those macro charts. I will, at least tomorrow, and I'm going to be very interested to see if anything has changed from a macro standpoint. I doubt it, but we'll see how that plays out. I'll show you the TNX real quick. I know a lot of people that watch the US market update prefer the 10-year over the 20-year. I like the 20-year because it's the middle of the curve, kind of the midpoint between the short end and the long end of the curve. But the TNX, is a highly watched part of the bond market, and there's all those triangles there as well. So it doesn't matter what end of the yield curve you're looking at, still a lot of uncertainty and unsurety in the bond market right now, just waiting to see where the next big move is going to be. We have a little bit of support down there at 42 on the TNX, slight tick up in rates, but nothing significant. It seems as though the bond market, this is the way I would summarize it, which, take it for what it's worth, just my opinion, is the bond market is unsure of the Fed's next move or when it's going to happen, but it seems to be leaning more towards the fact that there is a cut coming. It's just a matter of when. That's the way I summarize what the bond market is trying to tell us. And the VIX is still acting fine as well. We're not getting in, we've had heightened volatility throughout the summer. I've noted that numerous times. I'll show it to you one more time and then I'll stop doing this. But last summer, we spent the entire summer down around 12 and a half. This summer, again, heightened volatility a little bit where the VIX hovered at 15 rather than down at 12 and a half. And we've been down in this area for quite some time. And you wonder, if the Fed pleases the market, does that break us to the downside and we test 12 and a half? If the market or the Fed disappoints and with an 83% chance of something happening in September, no cut in September, regardless of what the bond market is telling us, I think the equities market would react adversely to that, at least for a short period of time. And we might see a spike up like we had here on Non-Farm Friday. I've dubbed that, as you all know, when we had that surprising non-farm payrolls report and then all the massive revisions that cost the head of the Bureau of Labor Statistics her job. We might see something like that on Friday if Chairman Powell is still staying with his hawkish stance and not wanting to cut rates. And you've heard all the arguments. I'll talk about that more in Thursday night because I do want to get to why we're here, which is looking at the AI and the signals that it has. But I am going to throw the dollar in real quick because it's acting well also. If we didn't have the dollar cooperating so well, I think we might have seen even more volatility in the equities markets. But the dollar is staying right in that Goldilocks area that I've been talking about, a pretty tight channel here between 97 and a half and 100. And it's been there since April. And I call this the Goldilocks scenario. You know what I have been stating. We don't want to see the dollar collapse. I think that would be bad. If the Fed cuts 50 basis points, we might break that lower trend line at 97 and a half. But we don't want to see the dollar come down too far. We are very dependent on foreign countries owning the dollar. And if it gets to the point where they're tired of losing money and they start dumping dollars, that creates all kinds of other problems to deal with. We're not there yet, and we could even go a little bit lower and still not worry about that. I would say even down to 95 would still be okay. But we start to break down going down to 92 and a half or 90. Now you're going to start to get all the commentary on the financial networks. Has the world lost faith in the dollar? So we'll see how it reacts to whatever the Fed does. And if the Fed doesn't cut, maybe we get another little bounce up like we did here during Non-Farm Friday, where we had just a slight little bounce in the dollar there. That kind of covers off the basics of the market. We'll get into other things deeper during the insiders meeting tomorrow night, but let's get to the AI. And the first thing that you may notice stands out to me is that when we're looking at the list, look how many stocks there are on the bullish side of things. That goes along with what the data scientists at HUBB are telling us, is that the macros for the economy are still generally pretty good. Obviously, as I mentioned, there are areas of the economy that are contracting, but in general, from an overall picture, things still look okay. And that's why we have so many on the list. Now, granted, the scores aren't very high, so it's kind of a tilt towards the bullish side, but not a let's jump in type of thing. The highest reading that we have is here on SBRA. And, we had that, for those of you that might have been involved, the big bounce up in UNH when it was disclosed that Berkshire Hathaway took a big position, and then that was beneficial. And the fact that some stocks other than just UNH have been finding a bid in the healthcare space. Healthcare is a little bit of a defensive sector. That's where money goes to hide. And clearly the rotation has been moving in those areas rather than looking at the bond market. So I find that quite interesting. And I'm going to show you something that we looked at yesterday during Trade Finder on the list. We'll go back a day after I get through today's listing here and show you what I'm talking about. as far as market rotation. So 65% on SBRA. I'm not sure what the liquidity is on the options. Let's take a look and see if it's even something to consider. And you can see there's a little, little more volume today on the call side, but overall, open interest is quite weak. So really not much we could do with this anyway. Still not quite high enough of a score. I'm still okay with a score of 70 or above, even though our primary target is scores at 75 or above. I've seen the 70 plus ones work just as well, but 65 is just a touch low there. And so we wouldn't want to do anything with that with the score. And then certainly with very anemic open interest on the options. And that's the September monthly option, no weekly options on SBRA. Now, another thing to look at, as you know by now, hopefully, if you're new and haven't heard this before, for those of you that have been with us week in and week out, bear with me for a moment to catch our newer subscribers up to date. But one of the things that the data scientists have talked to us about, I'm an old dog, I'm a little bit stubborn to vary, and it took me a while. They kept hammering me every week that, you can fade the lower signals. So even though this is a wave 3 bullish search, if you have a low signal, and what constitutes a low signal is a reading below 25, and so there's the scores. So you can see there's several of them here that once you get down below 25, you can look to go the opposite direction. In other words, trade to the downside rather than the upside. And we have Hog here right under it. That's Harley Davidson. And, from a general standpoint, you think of this move to the upside with oil staying a little bit elevated but coming back down. Perhaps people are moving into motorcycles. There's two main reasons. One, when the consumer has discretionary money to spend, they go get a toy, they go get a motorcycle, or when oil prices get extremely high and they use the motorcycle as a less expensive mode of transportation rather than buying some of the more expensive EVs that are out on the market. So there's two different reasons that a consumer may look at a motorcycle. And we had this move up, I believe, on the back of oil staying elevated for quite some time. We went sideways for a while, but I think there's enough on the fundamental side. For those of you that may not know my past, after I left the golf business as a golf pro for over 13 years, and then I was a registered securities principal, financial advisor for a couple years before they told me I couldn't trade options. Even in my own account, that's when I left that world. I didn't like it anyway. I don't like the way the institutions are set up. They're more geared for the bottom line on the institution than they are the account holders, those of us, the retail public, that deposits money. I attended a lot of meetings as a principal. I was expected to attend all these meetings, and that's all the rhetoric was. They never talked about what can we do to make our account holders perform better. It was always, what can we do for the bottom line of the institution? And it just didn't feel good. My point was, in that world of being a financial advisor, you're trained on fundamentals. Everything's about fundamentals. They don't talk technicals at all. And so that's where my training was. And I started trading that way until I was shown that technical analysis does indeed work. And then introduced to Elliott Wave in 2001 and have been trading it ever since. But I think that the midpoint is the sweet spot there. So I was a perfect example of going from one extreme to the other. Only fundamentals, no technicals. And then I went to only technicals, no fundamentals. Fundamentals don't work. They do work. They just take a lot longer. than technicals do. Fundamentals usually win out in the end, but it could be a very long time before the price of the stock actually catches up to their fundamentals. That's why you have stocks that are deemed to be underpriced by their peers or overpriced, et cetera, for periods of time. It just takes a while for the fundamentals to work their way through. So now a blend of two, technical analysis based on good fundamentals, which is what the AI scores do, containing those macros, et cetera, which I really like. And my long-winded story here is I think this would be a tough one to fade because there's still some fundamentals that may warrant this one at least staying sideways here and not coming all the way back down. It is a little overbought right now. So if you wanted to be ultra aggressive, you could try looking at HOG coming back down to the 10-day moving average, but it's only about a point move. And is that really worth it? Would you make enough money on an options trade to cover the transaction costs from getting in and getting out? It probably just doesn't make much sense. And then we can come down here and look at a few others with much lower scores that could be interesting. And when we're looking at something like the Plymouth Industrial REIT, I don't really like REITs in general. I found them not to move fast enough for the world of trading options. Obviously, they're securities and they move, and then you get this big, huge move to the upside here. I don't know if that was some sort of an earnings scenario or what caused that, probably what moved it up, but it is way overbought at this point in time. Normally, I wouldn't pay much attention to it because it is a REIT. But when you look at something like that, curiosity would bring you to want to look at the options chain and see where we are on open interest. And once again, very little open interest, too thinly traded, which makes sense because I'm not familiar with this company and I've been around long enough that I'm familiar with most symbols. But that one would have been enticing for a little bit of a quick pullback down trade because it's just so overbought at this point in time. And if you're familiar with the time strategy where we look for stocks that have had a big move lower and expected to stay sideways, you may wonder, well, why wouldn't the same apply for a stock that has a big move to the upside? You get a big, huge gap up like this. Why wouldn't you expect this to go sideways? Why wouldn't you want to do something sideways here, which we can't because we don't have the options, but just in general, from the theory, it doesn't work the same way. Stocks that have a big drop, it's almost like they go into shock. They kind of flatline, and that's where that sideways stuff comes in. But on a big upward gap, normally what happens is after a brief consolidation, you either fall back down or you take off and run. It doesn't tend to go sideways the same way it does on a downward move. So as you know, when there's not a lot of signals, I try to throw in a little teaching tip. And if you've ever wondered about that or thought about that, that's why we don't look for like a call calendar spread on a big gap up like we do a put calendar spread on a big gap down. I do want to look here at this MDGL, but it's pharmaceuticals, and they are so tricky, very difficult to trade. They're wild movements. You never know what's going to happen with these. It seems to be in the midpoint, so I wouldn't really be interested in that either. And then you look at Dayforce here, which is another one that had a big, huge move up. You can see a bit to the upside again today. And we'll see if there's any options available here. And it does have good liquidity. So other than the other ones that we've looked at, September, probably not far enough out. You'd want to look at least October. Now, remember, this would be a fade trade, so we'd be looking over here on the put side, on the right side, and looking at the deltas. There's it's actually got some activity today, 123 contracts traded already. Well, it's not volume, that's overall. It took the volume chart off. So only 123 open contracts altogether. But the spread's too wide. Remember the rule on the spread. When you're placing it, you don't want the cost of the or the width of the spread to be more than 10% of the midpoint. So if we're looking at 210 to $3, that's 90 cents. And if we were to pick the midpoint in here, call it 250, 260, so you'd be looking more like a spread of 25 to maybe even 30 cents. But that's much less than the 90-cent spread that we have. When you have something that violates that 10% rule, basically it means you're going to be giving away any profits that you might make in slippage by the time you get in and get out. The difference between the bid and the ask is going to be too wide. And market makers are great about sucking you in. In other words, they'll let you get in when you're kind of splitting the spread. Like you might be able to put a 260 price in there, $2.60, and they take that on the entry. But then if it's profitable for you on the exit, they're going to make you sell down near the bid, and you're going to pay the majority of the spread. And in this case, 90 cents. That's probably the entire gain that there would have been on the position. So it doesn't make much sense. So I really like that 10% rule on how wide of a spread is okay to trade and what's too wide. It's a good general rule there. As interesting as that one is, at least it has over 100 contracts. That's kind of the minimum that we look at as far as open interest. The spread's still too wide. So without that, that one would have been one that would have been tempting to put a fade trade on. And it'll be fun to watch it nonetheless. So you could just keep that on a watch list or some sort of a paper trade account, etc., and see how it trades. It's a good learning experience, if nothing else, to see if it were to tick back to the downside. So even when we're trying to find some sort of a fade trade here, there really isn't much available on that side of things. And then this ETF for convertible bonds. Convertible bonds are bonds that you can convert to the underlying equity. You can convert it to an equity. And really, even though it's ticked down a bit and it only has a 14 score, it doesn't move a whole lot. So there's really not much of interest across the board here on the bullish side, even though there's so many results. We switch to the bearish side. Highest score is 57 on the one that we have, FMX, Fomento. It's an ADR, so it's an international company. You can see the move lower here and a bounce up today to test the 10-day moving average. We broke a little bit below the 10-day moving average yesterday, so we're just getting a slight bounce back, testing that. That would be interesting if the score was higher. And I'd just be curious to see what do the options look like here. Not a commonly talked about security. And again, kind of low on the open interest on the call side. But a lot of people betting to the downside here. You can see a lot of open interest, good open interest on the put side, and yet the spreads are still a mile wide. So there's a lot of people that are going to need that stock to move a lot to overcome the width of that spread. You've got a $3.70 spread here. It's just too much, even though there's 899 contracts. That's when it gets really frustrating for me, because when you have good open interest, the spread should be tighter. This is when you just stay away, because that's the market maker's wheelhouse. They're in control there. They're the ones that are going to make the gains off that. It's very difficult for a retail trader to make a profit on a move like that unless it's an extraordinary move. And in this case, it's not expected to be. We're going from 85 to 80, 5-point move. Once again, the profits probably barely cover the slippage in the commission, the spread slippage, covering the transaction costs getting in and out. But another one that would be curious to keep an eye on and see what happens there. The LA wave showing that wave 3 is still active to the downside, so that still looks pretty good, but nothing that we would want to do anything with. I wanted to update you on the Wave 5 bullish fade trade. I mentioned this in the last couple of weeks. I know we've had to miss a couple of these events, but when the right one comes, pretty much ready to go with a calendar spread versus a butterfly as a fade trade on the Wave 5 bullish search. I think I've got enough data calculated here in order to feel comfortable enough to send out an alert on one of those, and be sure to let you know in the commentary exactly what's being looked at here. But once we get a signal that has liquidity and is a viable candidate, but nothing on the Wave 5 bullish side right now. So let's go ahead and take a look at what's happening in the sideways market here. And you can see that we do have a score here on VKTX, but it's a therapeutic. So it's in that area where things can move. It sure is tempting, though, isn't it? With a score that high and the fact that it went sideways for so long through May, June, and early July, which would be exactly what we're looking for now. And then kind of moved up, went sideways again, then went vertical, and bam, right back down. But to expect it to go sideways here, we just tend to try to stay away from these. As tempting as they are with the scores that high, it just the history hasn't been so positive with anything in the pharmaceutical, therapeutics, those kind of sectors have been proven to be very difficult to trade. Even though the open interest isn't very high, the spreads are a lot more reasonable over here on this. But let's see what that's the weeklies. So you would expect there to be more liquidity because it has weekly options. So obviously heavily traded. And you look over here on the open interest when we get to the September monthly option, lots of open interest here, plenty of it, and much tighter spreads. So that part looks really good, which makes it quite tempting. I'll do a little more research on this. It's just immediately when you see that it's a therapeutic stock, you kind of want to stay away from it. But with that kind of liquidity and that high of a score, it does warrant more consideration. So I'll do some research on that after we finish this broadcast. You may see an alert come out, you may not. It's just it does get lumped in again with those sectors that just tend to be stay away, don't touch type, but sure is tempting, isn't it? And then once again, for those of you that are new, when we start to look at the low scores on the sideways, the fade trade is expecting the exact opposite of a sideways move, a breakout move. But it's a $9 stock. So normally the scenario would be to put like a strangle on the way we set up the strangles for a breakout move. But it's probably not going to be enough of a breakout move, even if the options are viable. Let's just take a look and see what they look like, just out of curiosity. But we'd kind of stay away from that anyway. So we'd be looking October at the earliest for a strangle, and no open interest on those. So we don't have to worry about that or get kind of tempted into doing something along those lines. And if you're wondering on the strangles, again, another just general teaching rule, I tend to stay away or try to on anything below $20 for a strangle, because you want a decent enough move. We're looking for a 10% breakout move to do a strangle. That's where you can expect to get a pretty good profit. The 30 to 70% that we eye in strangles, you need about a 10% move of the stock price from the midpoint. And even though we technically have that with where these boundaries are, just not something that I like to do generally. It's rare if I do a strangle on anything below $20 and it has to be pretty close, like maybe $17, $18 maybe. But $20 tends to be the line in the sand. Just too hard to make money on the lower dollar stocks out of a strangle, even though we have a low score here and the potential for this to come back down. It got a little vertical. It's retraced that vertical move. It's sitting on a little bit of support right here from those July highs. So there's a lot of things that you could take from this as far as holding support and a potential move up or breaking that support. And then the next level would be back down here is the next level of potential support, that pivot point low that occurred in the early part of August. And another thing I want to talk about, if you've heard about pivot points and you're not sure exactly what they are, this is a great example of what a pivot point low looks like. So a pivot point high would be the opposite. So you have a bar that has this low, then you have another bar with a lower low, followed by a third bar with a higher low. So this one point here is known as a pivot point. So that's a pivot point low there, which would be the next area you would expect this to come down to if it didn't hold right through there around $8. So even though it's not anything we would consider sending out an alert on, it does give me an opportunity to throw in a few more points of consideration along your trading journey and keeping that in play. So what I want to do is go back to yesterday's list and show you one that I thought was interesting. We'll go back over to the Elliott wave search and on the bullish side of things. And this kind of shows you a bit of what I was talking about regarding market rotation. And you can see here DXJ, which is an ETF for equities in Japan. We had gotten a tiny bit overbought from the 10-day moving average. We're correcting that now. A couple things to look at here, which we did look at in Trade Finder yesterday, if you were there, is the fact that we have the zigzag pattern with a 50% B wave here that you expect 100% extension, which is exactly where we went. So you get a perfect 50% B wave correction. You expect it to go to 100%, it does. And as you know, oftentimes this C wave will go to the next extended fib level. Not all the time, but enough that we pay attention to it, especially if you have a strong DMI, which I'll bring up. The AI target is all the way up here. Now, again, it's a lower score at 62%, more than a coin toss, he tried to say, up there around 135. And then you have the 161.8% fib extension level at about 132. So that level seems to be a viable level to watch. It's below the AI target, and it's the next fib level if the DMI looks good, and the DMI is constructive at this point in time. We are getting a tick down in the positive directional indicator now and a tick up in the negative, but the ADX is broken above 25. There's still really good separation between the two directional indicators. The ADX has moved above the negative directional indicator. So the positive and negative directional indicators, as you're probably aware, are more susceptible to day-to-day movements, more responsive to day-to-day movements. The ADX is a little slower, a little bit more of a lagging indicator. And so you would expect that these little blips on the positive and negative directional indicators wouldn't directly affect the ADX immediately. But looking at this, I find this one very interesting as far as could we hold this 10-day moving average? So the little bit of a move down today is not surprising at all because it was a little bit overbought. It's been a while since we've tested the 10-day moving average. We got to go back to the beginning of August since we have. It stayed slightly elevated. So to me, this is just a good solid corrective move. You can see it did it here in mid-August where we came down here and had a little bit of a move down similar to what we're seeing now, got closer to the 10-day moving average and sprinted up. Could it do it again and sprint up to that 161.8? I think that one's quite interesting And let's go ahead and take a look at the options here, see what they look like. Probably November would be something that we would want to take a look at, but not a lot of open interest in the November monthly options, unfortunately. Let's see if October gives us anything better. And no, so it doesn't seem like option traders are paying as much attention as the institutions are with the rotation moving into some foreign stocks. And there's a lot of trading being driven by retail traders right now, and they're the ones that primarily do options, and they're just not quite as interested in things overseas. So even though this looks like a pretty darn good setup, at least for the short term, staying above that 10-day moving average, you just you don't have the open interest. Considering how low the open interest is, the spreads they're wide, but they're not a mile wide like some of the other ones that we've looked at, even with low open interest. And if we go to January, sometimes the January months are interesting because people that trade leaps use the January options. And oftentimes, as you move into September, October, those January options can be very liquid, and it's a good month to put on option trades because of the increased liquidity, but it's not there for January of 26 either. So, you got to have both pieces. We've talked about this numerous times, right? Yeah, you got to have the technicals. All those look pretty decent, but you have to have a viable options trade as well. And there's two sides of the coin. And then looking on the fade side of things, if we were to look at SRDX, Surmatics, which I don't really know what that is. I'm not familiar with this company, but again, even if it were to move down, it's not too big of a move. I'd be surprised if the options were very liquid on this, but maybe let's take a look. There's more liquidity than I expected there to be, at least on the call side. People are pretty bullish on this stock. Options heavily leaning on the call side, which would kind of make you a little bit uneasy just from that standpoint. If we went out to November, you look at this and it would make you uneasy if you're long, is what I'm trying to say. But from a fade standpoint, that's what you want. You want everybody on the call side. You know how the market works. Path of least resistance is the opposite. When everyone focuses on the market one way, the path of least resistance is a move in the opposite direction. So the fact that there's more liquidity on the call side than the put side, I would view as a positive normally. But here it's anemic though, right? I mean, there is some better liquidity on the call side, but it's not like people are knocking down the door to trade call options on this stock. So that kind of covers off what I wanted to share with you today. There's not much else to go through from an AI side of things. So with that, Zach, I'll go ahead and open it up to any questions folks may have.
Sounds great. Yeah, let's get right into it, Rob. Got a couple questions here from Maria for you. First one is, hi guys, nothing is finalized, but hasn't the UE agreed to buy 750 billion of US energy, including natural gas from the US? Shouldn't that be giving natural gas a bid?
Boy, Maria, we've been talking about this. I don't know what it's going to take to give natural gas a bid. We just have so much of it. At least it did stop a little bit of the downward move, and we're also sitting right down here at 100% extension. I'm going to take the DMI off because, I don't really look at that on downward patterns the way I do upward ones because downward moves tend to happen more quickly. And with the DMI being a bit of a lagging indicator, sometimes the moves can happen earlier, but a real aggressive trade. We are right smack in the middle of the tap box here. We are at 100% extension, which is what you would expect, roughly a 61.8% wave 4 correction there. And, we're in August. The market usually looks 6 to 9 months ahead. Wintertime is coming. I've been kind of curious, opining a bit, if you will. Clearly, areas of the country had much warmer than normal summers. Does that equate to potentially much colder winter in some areas of the country? As I said yesterday, when I was talking about this at Trade Finder, I have not looked at the Farmer's Almanac. I don't know what the forecast is for the weather for this winter. But the issue here is going back to the crux of how the markets work, supply and demand based on fear and greed. And in this case, supply, we have so much natural gas. The U.S. is the Middle East of natural gas. We know the demand's going to be there from all the data centers that are being built, et cetera. We know all that stuff is very positive from a fundamental standpoint. And then what you just mentioned, Maria, the UE going to buy a whole bunch of these. But it's just a whole bunch of natural gas is still not enough to overcome the supply demand ratio. But at some point in time, the sellers will get exhausted and you'll get a reflex bounce. Maybe something like this can start that. In other words, if we can kind of go sideways and tick up a little bit, you can see this little sideways move here. I thought maybe at the end of July and early August, maybe we were basing here, we were in the tap box. But nope, we just didn't get that push higher enough to run the shorts out. But they will get exhausted at some point in time. And I do think that once we get a bounce in natural gas, it might be an exaggerated bounce to the upside due to the fact that there'll be very few sellers left. You're going to have, if some buyers will step in, and at some point in time, they're going to look at something that's grossly undervalued, and rotation will come in, and they kind of throw out the supply demand thing at that point in time. They just look for where's a sector that's really, really oversold, where's one that we could make pop just with a little bit of buying. So I do think we will see some sort of a blip up in natural gas, but I don't know if it's going to happen right now. If you had some discretionary money and you were looking for a very aggressive trade and you had some patience, I would go out in time. This wouldn't be, like a 60-day out option. This would be like 4 months, 4 to 5 months. I think you would want to give this, give it plenty of time, and perhaps we catch a little bit of a move back up in natural gas. But I'm with you, Maria. It's just frustrating, waiting for some sort of a catalyst to move natural gas higher.
Very well. And a question from Maria on Google, GOOGL. Zigzag starting July hit 61% target. Are we just testing the prior fib, or is this party over and we're starting a wave 4 down? Thanks.
Don't know. It's had a really nice run higher. It's been on that 45-degree angle. The algorithm still has the wave 3 as active. It's not convinced the wave 3 is finished yet. I think Google is just reacting to what all of the big tech stocks are doing right now, which is taking a little bit of a pause. You could argue that Google's not quite as overvalued as some other stocks are, even though it is a bit in the upper end of valuations, but not quite as high as some other tech stocks. But I'm kind of watching this one myself. It might be being a little greedy here. I would kind of like to see Google come down to 190. It may not get there. It's at 200 now. It may hold there. And I think we're just going to have to wait and see what happens with Jackson Hole in the September Fed meeting. A rate cut, I think, puts a bid back under the tech stocks. Without that and their valuations, it's hard to imagine another leg up in the big tech sector without some Kool-Aid, as I call it, from the Fed in the way of rate cuts. We have this move down below the 10-day moving average right now. We'll see if it closes back above it at the close. Where we are at the end of the day will matter a lot. The selling in the market has not been all that heavy. It's just we're kind of on what they call a buyer strike. Like nobody wants to step back in. They got the market got a little shocked with the hawkish nature of Chairman Powell's last comments during the press conference after the FOMC results. You can see that there's been some selling here, but it's not significant at all. Not even nearly as bad as it was there on Non-Farm Friday. So this is just a buyer strike where the buyers have stepped away. They're letting the sellers have it. And again, if we get the rate cut, which I do think is what we need for another leg higher in anything equities based, including stocks like Google, they're just going to languish a little bit, I think. But I'm watching that one too. Maria, I think that there could be a great entry there if we get it down to 190, close to the 50-day moving average. And I don't know that we'll see it come down that far, but that would be pretty interesting to me if we see that. I don't know if that's enough of a correction to create the wave four. We'll see how things pan out over the next few trading days. But for now, this is just and a lot of the same things from the tech sector as I mentioned. It's more of a buyer strike than sellers stepping in and taking control. We're not there yet. They would be buoyed if Chairman Powell is still as hawkish as he was, and then we start having the whispers of no rate cuts at all this year. I think that changes things dramatically. So, as I said, he knows he's about to face a barrage of questions, and I don't think he's too excited about it. But it's going to be a very, very heavily watched, one of the probably more heavily watched Jackson Hole summits that we've had in a very long time.
Thanks, Rob. A couple of symbols for you from Jay. Can we look at LUNR?
LUNR. I thought we were going with Lulu there for a minute. We started with the LU. Intuitive Machines, it's breaking below 10. The question, and you've heard me talk about this a lot, and we're gonna have to look at volume on this, and I'll explain why. But when you have something that goes sideways like that, you look at where's the institutional ownership, and I don't know what it is. It's not that hard to find anymore. It used to be a little more difficult to find institutional ownership. Now you can just Google it and find out. AI, Gemini, whoever you look at for AI in your various browsers, etc. You can find the institutional open interest because $10 is a very important price. And just as a recap, some of you have heard me say this numerous times. For those of you that are newer that may not have heard it, when mutual funds, investment companies, etc., set their investment objective, only institutions with aggressive growth is their investment objective can own stocks under $10, and they can go down to 5, and they're not even allowed to own stocks under $5. If your investment objective is growth and income, etc., you can own stocks at $10 or above. So when you see a stock like this that broke above 10, you would want to look at the volume there. So let's put the volume on. And there you go. There's the spike. So there was some institutional buying. Some new buyers came in, pushing it above $10. Now they can own it. So it's funny how I had the arrow right on it. And then when you break 10, you want to look at the volume to see what the institutions are doing at that point. Are they stepping in to support the stock, or are they bailing? There's an amount of time that they're still allowed to own stocks if they break below 10, but there will get to a point based on securities regulations where they're forced to sell. So oftentimes they don't want to. Then that means they have to realize the loss. If they can come in and support it and get it back above 10, maybe try to generate a short covering rally, which would allow them, if they want out, to get out at a better price, or if they want to hold it for the long term, it gives them the opportunity to do that. But there are some that did bail on this break below 10. You can see they just immediately got out. There is some support down here around 750, but that means that the people that stepped in when it broke above 10 would probably come out, and then you'd be left with the institutions that have aggressive growth, which is smaller in volume than those that have growth or growth in income, to see if they're going to hang in there or not. So I would be very leery of this one unless we saw it hold 750 with some volume, something like this that we had in May. You would want to see that come back in when it hits this support at 7.5. So I think you got to watch this one for the next couple of days. And if you want to go short it, a break below 750 could be an amazing short. Probably going to go down to 5 rather quickly if it doesn't hold 750. So I'm not sure what direction you're looking at, but those are the thoughts there.
Thanks, Rob. Yeah, Jay said looks like it invalidated the wave 4 today. Wave 4 was in the 70s yesterday, and then a follow-up symbol is BBAI.
Bio Bear Holdings. Oh, Big Bear. Sorry, Big Bear Holdings. You see the wave 4 there. These lower dollar stocks here can be tricky. Big volume came in, and here's where you're trading kind of on the pink sheets, etc. And then as it breaks above 5, another example of institutions stepping in. So there were some aggressive growth institutions that wanted to own this, and they piled in when it broke above 5. And then not sure what happened here, if that was earnings or what. But for now, it's holding 5. Barely holding the wave 4 at 68%, but it has a little bit of room there. Hasn't even gotten to 70%. But this $5 level is key. This one I find more interesting than the previous one. I would watch this really close, and if we can get some sort of a bounce here off of this with a little bit of volume behind it, that could be a great entry as it runs back up towards that 8 level, which is where the next area of resistance would be. You could get a little bit of a bounce higher on this one at that point in time. If you're a little more conservative, you want it back above the 10 and the 50-day moving average first. So an aggressive move would be a bounce off of 5. More conservative move would be a break above 6, above the 10 and 50-day moving averages. But yeah, that one's kind of interesting.
This next one's going back to the PLYM chart that you showed a bit earlier. David said got an unsolicited offer to buy all outstanding shares at 24 a share. So just some context there. We have a question here from Brian who said, glad you're back, Rob. Nothing like trading on my birthday. So happy birthday, Brian. And would like you to look at GLD.
Yeah, happy birthday, Brian. And thanks for the welcome back. Sorry about the absences. Feeling much better. And then we look at GLD, and all I can say is it is coming. There is a big move coming on GLD. Can't tell you which direction, other than that is an extremely well-formed triangle, long in the making, several months here. A nice set of lower highs and higher lows, and I've gone ahead and drawn in on an upside breakout. We probably push towards 330. On a downside breakout, maybe 290. So many people are spouting all the reasons why gold should be going higher. And we'll see. You could see a scenario if the Fed does surprise, well, not surprise because the market's expecting it, but if Chairman Powell comes out on Friday and does act a little more dovish and does kind of hint, I don't think they're going to declare it, but even hint that September could be on the table for a cut, data dependent, I'm sure is going to be in the speech. That's one of his favorite terms. Could push the dollar down and therefore drive gold higher. So that's a scenario where I think you get a legitimate reason for gold breaking higher. So the Fed does hint at the cut in September, dollar goes down, gold goes up. And perhaps if they're going to continue to stay as hawkish as they have been, the dollar gets supported, maybe runs up like that last spike up and gold breaks down. So you could make scenario cases either way. The only thing I can tell you is when it moves, it's going to be a significant move. It'll be a fun one to watch. It's coming. It just we have to wait and see when. It's got such a low ADX there, and a little bit of a bubbling up here, the volcano analogy with lava bubbling underneath. It almost looks like GLD itself is itching to make its break. It's like we want to break out too. So yeah, keep an eye on that chart because that's going to be a nice breakout move at some point.
Thanks, Rob. I see we're a couple of minutes after time. The last question for today's session is going to be from Jonathan, looking at a potential call calendar idea on TPR. It was a sideways signal on the 14th of August with a score of 79.48. 79.48.
Good old tapestry. Let's see what do the options look like there on tapestry. We would want to look at September at this point in time. Does look pretty good. Waiting for the internet to catch up here. There we go. Yeah, there is some open interest, and you want to call counter spread rather than on the put side, which at this point in time I think would be interesting. And I wonder if you're considering the weeklies at all. On the call side of things, I think is where you can consider using weekly options. If we go out to the September monthlies, still some decent open interest. Depending on the strike, we're right around 100, 173 contracts on the put side. Lots of contracts on the call side. Maybe that's what you're looking at there. I tend in general to prefer put calendars over call calendars, but sitting right on the 50-day moving average, I like that. I think you might be on to something there. I'll look more at that one after we finish this broadcast as well, but good on you for catching that.
Alrighty. Thanks, Rob. It was great to have you back. As I echo the subscriber sentiments as well, and looking forward to our insiders meeting tomorrow night. But that wraps up all the questions for today's session. So over to you.
Sounds good. And you know what the main topic's going to be tomorrow night? We'll be talking about, we're finally at Fed Day, and the joke of Friday is going to be an interesting day, maybe more so than even the other times when we've talked about that. So thanks everybody for taking part of your trading day to be with us, and it was good to be back. And hopefully we'll be talking to everybody tomorrow night during the insiders meeting. Have a great rest of your trading day. We've got a few things that are going to be interesting to see where they close today. Again, so far the technicals have not broken down, but too much more downside before Friday would create some complexity, is the word I'll use, going into Chairman Powell's speech on Friday. But man, that's going to be big. Anyway, I'll stop rambling on. Have a great rest of your trading day. Hopefully we'll talk to you tomorrow night. Take care, everybody.